Hello, everyone, and welcome to Moementum channel. Today, we're going to be talking about two undervalued dividend stocks that are in consumer staples sector, and they've been paying their dividend uninterrupted for over 40 years. So without any further ado, let's get into it. The very first undervalued dividend stock for us to take a look at is a company called Walgreens. Walgreens has a history dating back to 1901 when Charles Walgreen bought the Chicago drugstore where he had worked as a pharmacist. And since then, the company has gone on to open thousands of new stores throughout America. And they took its business worldwide in 2014 after merging with Alliance Boots, Europe's biggest pharmacy chain and a leading international beauty group. Walgreens Boots Alliance is traded on NASDAQ with ticker symbol WBA, and the stock pays a dividend annually, yielding 3.92% at this time. Walgreens has a market cap of $42.5 billion, making it a large cap size company. Overall, Walgreens' convenience store footprint, large economies of scale, and investment in store improvements have enabled the firm to be one of the world's most important health retailers and supplier of vital medications for decades. From a stock volatility perspective, Walgreens has a beta of 0.61, which is considered to be low volatility. And for those of you who might not be familiar, beta is a measure of the volatility or systemic risk of a security or portfolio compared to the market as a whole. A beta value that is less than 1 suggests that the stock or that security is theoretically less volatile than the market. And including these type of stocks in a portfolio makes your portfolio less risky as a result. In terms of some additional key metrics, for the dividend, the payout ratio for Walgreens currently is at 34%, which is considered to be low for consumer retailers. What's more, the forward payout ratio is at 41%, which starts to edge higher a little bit for consumer retailers, but it still falls within the bracket of 20 to 60% for the payout ratio that we'd like to see in dividend paying stocks, giving them a ton of room for them to increase their dividends for many more years to come. You notice that Walgreens has been paying its dividend uninterrupted for the past 46 years, which is just remarkable. And in the past 20 years, on average, they have increased their dividend 14% per year. Of all those 46 years that Walgreens has been paying its dividend, they have increased their dividend year after year. And currently, they do pay their dividends on a quarterly basis. These are paid on the months of March, June, September, and December. And the annual payout per share is at $1.91. Looking at the valuation for Walgreens Boots Alliance, their current dividend yield of 3.92% is 19% above their own 5-year average of 3.30, which indicates that now could be a reasonable time to invest. What's more, their forward price to earnings ratio is actually a lot less than that of consumer staples. This could suggest that Walgreens Boots Alliance is actually a lot cheaper in comparison to the overall sector. But sometimes it could also happen when analysts and overall the investors are not perhaps as optimistic about the stock. But we're going to take a look at a number of additional financial metrics to have a better assessment of the scenario. Before we do so, though, let's take a look at the 1-year price range for the stock. The last trading price of the stock at $48.73 at the time of making this video is hovering slightly closer to their 52-week low price, which was at $43.72. In the past 1 year, the highest price that the stock has hit was at $56.80. In terms of earnings per share, ideally would like to see this metric showing gradual and continuous increase over time, year after year. For Walgreens Boots, that's not exactly the case. We see a little bit of that seasonality, and also there are certain years that the company has done better. For example, 2018 and 19, they had two of their highest earnings per share in the past 10 years. And in the last 12 months, they're only showing at $5.49 earning per share. And in the next 12 months, it's actually even going to be lower than that, estimated to be at only $4.68. If that remains true, that shows the earnings per share declining by about 15%. That perhaps suggests why the stock price for Walgreens has had some hit recently. In terms of outstanding shares, we'd like to see a company over time that has the buyback of its own shares and reduces the number of outstanding shares. It does appear to be the case in the last 12 months Walgreens Boots is showing 867 million outstanding shares, which is less than the past 10 years, with the only exception being 2021, which they had 866 million outstanding shares. Overall, that is a good sign. We are glad to see the number of outstanding shares kind of going down. And lastly, we're going to also take a look at total sales, which is reported in $1 billion. We'd like to see this number growing year after year, ideally steadily. And in this case, the last 12 months, the company is showing $135 billion in total revenue, which is the highest amount that they've had in the past 10 years. Return on equity is another metric that we're going to take a look at before we move on. And that is actually measures how many dollars of profit a company earns for every $1 that shareholders have invested in the firm. In this case, when it comes to consumer retailers and consumer staples sector, we'd like to see this number to be above 22%. And in the last 12 months, they've actually hit that and just made it at 22% and above. Looking at the stock return over the past 1 year and the past 5 year, you notice negative returns in both of those time periods. In the past 1 year, the stock was down by 3.33%, and in the past 5 years, it was down by a massive 43% negative. That's not a positive return, but actually negative return. While this is definitely disappointing for long-term investors and investors who are also hoping to get some appreciation, in the meantime, admittedly, for long-term investors, the dividend security is also something of great value, particularly if the investors are more of a longer-term investors and they are not necessarily thinking of cashing out or selling their existing stocks. They are counting more so on that reliable dividend payment, which has been hovering around that 3 to 4% dividend yield. And we saw company has been paying its dividend for 46 years. So that's the level of security that comes with these type of solid dividend payer companies. Next, we're going to take a look at analysts and their coverage by analysts on TipRanks. There are 8 analysts here covering the stock. 1 of them have a buy rating, 1 of them have a sell rating, and 6 of them have a hold rating at this time. Though the average price target for the stock, according to these analysts, is at $55. And if that holds true, that shows an upside of 12.94%. Analysts on Yahoo Finance have a slightly more conservative price target at only $53.55 in 1 year. And lastly, analysts on Simply Wall Street have assessed the fair valuation for the stock to be at $142.55. And according to those analysts, this stock is showing to be undervalued by 65.5% based on its fair valuation. Before we move on and take a look at our second undervalued dividend stock, I have a big favor to ask you. I put a ton of time and effort to put this video together, and I appreciate in return if you can give this video a thumbs up and subscribe to our channel. Thank you. All right, our second undervalued dividend stocks in consumer staples and consumer retail is Clorox. It is available on New York Stock Exchange with ticker symbol CLX. And Clorox started back in 1913 when 5 businessmen invested $100 each to start manufacturing and selling the firm's bleach. And since then, they've expanded their portfolio, spanning across multiple categories, including cleaning products, wipes, laundry, bags and wraps, food, charcoal, water filtration, and cat litter. In this case, Clorox is a dividend-paying company that has a dividend yield of 3.21% and has a market cap of $17.4 billion. The dividend safety score for Clorox is at 75, making it a safe dividend payer. And look at the beta; it's slightly different, and in fact quite unusual compared to other dividend-paying stocks that we've seen so far. Here we have a negative beta, and what this suggests is that the stock is actually inversely correlated to the market benchmarks. So if let's say the market tends to do better overall, and let's say the market is doing better and is more volatile, then the volatility level for Clorox is opposite to that and is reversed in that sense. Next, we're going to take a look at the additional metrics for dividends, for example, payout ratio. Here, you'd see again another unusual payout ratio is more than 100%. And what it entails is that Clorox is actually utilizing all of its earnings to be able to cover the dividend payments. That's usually not a good sign, and definitely some bit of a red flag for the dividend investors. In the meantime, though, the fact that Clorox has been able to sustain and maintain its dividend payment for the past 44 years, and in all of those years continue to increase it, that kind of at least is some reassurance for investors, and that the track record and history of this company has been quite positive. So most likely the company would be able to kind of sustain and go through these difficult times in terms of that payout ratio and improve it. And in fact, as you noticed, the forward payout ratio is better. This is going down and reaching the 90%, although it's still high for consumer staples, but at least it's an improvement compared to 103% payout ratio. Looking at the annual payout for Clorox, they do pay an annual dividend of $4.64, and this dividend in total is actually paid based on 4 payments on a quarterly basis in the month of February, May, August, and November. Valuation perspective, their forward price to earnings ratio that you notice for Clorox is that actually 27.9 is above their own 5-year average of 24.7, indicating that stock looks somewhat expensive compared to how the market has valued it in recent years. That being said, though, we want to also point out and bring to your attention that the stock, just at the time of making this video today, hit its 52-week low price. Although after it hit that low price, it recovered back and ended the day on a positive, close to 2%, and ended at $144.54. We also wanted to point out for you that their current dividend yield of 3.21% is 27% above their 5-year average of 2.53. Whenever that happens, that could suggest that the stock is actually attractive and could be a safe dividend payer, and potentially could be also reasonably priced. But we're going to take a look at additional financial metrics because some of these metrics that we've looked at so far can be somewhat confusing and in some cases even contradictory to each other. Let's take a look. First and foremost, when I look at earnings per share, what really jumps out at me is that how the earnings per share suddenly has dropped. And that could again suggest why the stock has really kind of tanked in a sense. Although the company has not announced its latest earnings yet, and later in February they would do so. Nonetheless, you notice from the last 12 months, the earnings per share is only at $4.44, which is the lowest that they've seen since 2015. That's definitely not quite a good news. The next 12 months is still definitely lower than what they have had in many other past 10 years, but it's showing some improvement by about 16%, expected to reach $5.17 earnings per share. So definitely we want to keep an eye on this. A little bit of points for us to keep in mind and make sure that the fundamental for the stock is solid. Again, although the company might be a solid, reliable dividend payer, we want to not forget some of these other financial metrics and whether the company actually has room for it to grow and appreciate over time in terms of its stock price, or is it just a dividend payer but not perhaps too much chance of it improving or increasing its revenues or earnings. We'll take a look. Let us take a look at the actually total sales. Here, the story is different. You notice that continuous gradual improvement in terms of total sales. So what it tells me is that from an earnings perspective, although the company is increasing its revenue, perhaps its margins are not being sustained over time, or its expenses actually growing over time, which impacts its earnings and the ability to have earnings on a per share basis. For the total sales, in terms of the last 12 months, the company is showing $7.08 billion in total sales, which is the highest in the past 10 years, with the only exception being at the year 2021. As for outstanding shares, the number is declining nicely over time, which is positive for us to see. In terms of return on equity, the threshold for consumer staples is 15% or above, and they've met actually that target. And in many years, in the past 10 years, they've had some anomalies. Like for example, in 2013, they've had an insanely high return on equity, and in the previous years as well, it's almost high double digits. In the last 12 months, they're showing 27%. We're going to take a look at the stock return in the past 1 year and 5 year. In the past 1 year, the stock is down by close to 23%. It's a huge decline, and you notice how A few days ago, in early February, the stock actually quite had a steep decline from the price of around $170 or so, all the way down to close to $141 today at its lowest point. Since then, though we talked about today, the stock rebounded a little bit. In the past 5 years, given and despite this 1 year decline, the stock is still showing to be up by about 7.73%. These massive declines, as long as the fundamentals of the company is intact, could provide opportunities for patient investors who want to take advantage of these massive drops to kind of pull the trigger and gradually perhaps buy the stocks if that's something that intrigues you or interests you. We're going to take a look at analyst coverage. There are 14 analysts on tip ranks covering Clorox, with one of them have a buy rating, 4 of them have a hold rating, and 9 of them have a sell rating. So according to analysts on tip ranks, the stock is considered to be a moderate sell. Those analysts are not necessarily at this time encouraging the buying of the stock, which is why, sometimes if the timing might not be perfect, although the stock might be undervalued, you might want to add it to your watch list and keep an eye on it to see how the price of the stock changes over time, and perhaps only pull the trigger when the stock price has gone even further down, so you get it at a much better bargain. In this case, these analysts have an average price target of $148.71, and that shows only an upside of about 3.2%. Not the highest upside in potential in that case. Analysts on Yahoo Finance, though, have a price target of $149.43. Slight different there. And lastly, analysts on Simply Wall Street have this stock valued with a fair valuation of $259.95, suggesting that this stock is undervalued by 45.6%. Well, there you have it, folks. A quick look into 2 undervalued dividend stocks in consumer staples sector that dividend investors could add to their watch list, keep a close eye on, and when the price is right based on their analysis, they could pull the trigger and add them to their portfolio. What was quite outstanding about these 2 companies, though, is the mere fact that they are such solid, reliable dividend payers for over 40 years, close to 44 to 46 years for these companies, and they've increased their dividend year after year in those years. That makes them quite unique in that sense. Also, you notice how their beta was quite low. One of them, in fact, had a negative beta. These consumer staples company could be good options when the stock market is quite volatile and when you want to lower the volatility in your portfolio. I hope you found this video beneficial and gained something of value from it. If you did, don't forget to give this video a thumbs up and share it with someone who might benefit from the video as well. Subscribe to our channel here on Moementum. Here on Moementum Finance, we post every week. You notice several videos about investing, whether it's investing in the stock market, cryptocurrency, and real estate, as well as ways to reach financial freedom. Thank you, and we hope to see you next time.